welcome to the Powers in Your Pocket. This is part 2 of the interest calculations series. So in the first part, I explained what a pre-agreement statement and quotation is. So in this quotation, this is where you're going to get all the figures or the numbers that you need in order for you to calculate interest. But now it's important for me to show you what an amortization schedule is. So I know some of you are sitting there and thinking, what in the world is amortization, you know? So what is amortization? So amortization is the process of reducing or paying off debt by making regular payments. So I'm not even going to waste time. Let us just go straight into it. So here's an example of a quotation. This was my quotation for my home loan facility back in 2015, right? And it has all the information that was stated in that document from Bank CETA. So you find the principal debt right there, and it also shows you the bond, the property in which I was bonding, right? And then here's your initiation fee. And then this additional amount is not very important for this particular episode, but what it means is that a bank will add a bond amount just in case, you know, a client defaults, so that they're able to claim more money than the actual price of the property. There are other costs such as interest, fees, and charges that they might want to recover in case a client defaults. So I'm going to skip that. Here's the monthly service fee that I spoke about. This was my interest rate. And then the total charges on interest. And it says interest will be calculated on a 35-day year regardless of whether the year is a leap year. So what this means is interest is calculated daily, and this is compound interest. So I'm going to show you the difference between simple interest and compound interest. So this amount is interest only over the 20-year period in which the bank was willing to give me a loan for. And you can see right here, number of payments, 240 payments. If you divide that by 12, you'll get 20 years. The installment is right here. And then it also shows you that if you decide to take this amount over the full period, and if the interest rate remains the same for that entire period for 20 years, this is the total amount that I would have paid for this property, right? So this is just an example of my home loan, and every single loan that you take up, no matter how small it is, whether it's for a personal loan, revolving loan, for an overdraft, it will have all this information. So here it says original repayment amount. The reason why it says original is because interest rates tend to vary. So when the repo rate increases or decreases, the banks adjust the interest rate, and you can even go and change the interest rate at a particular point in time to show you how it changes your loan repayment. So it gives you a loan start date, and the repayment type is end. What this means is that the repayment is paid at the end of the month. So it's paid in arrears and not in advance. Okay. So like I said, so my okay, this start date is fine with me. It says April 2018, which is not when my loan started, but that's not what is important. What is important is this column right here. But let me show you. So the opening balance is that much. The loan repayment is calculated to be that much. So this 9,445 and 86 cents is broken down. You can break it down to the interest paid and the capital amount paid, right? So when you pay your first repayment for your home loan or any other loan, be it personal, revolving, the loan agreement will state how much the repayment will be, and this is how it's broken down. So these two amounts add up to that amount, right? This amount belongs to the financial institution, belongs to the bank. This is what they're charging you for lending you money. And after paying this installment, this amount is all you would have paid back in capital from this amount. And this amount minus the capital repaid is the closing balance. And here it shows you the percentage capital outstanding. So this alone should scare you for you to stay away from unnecessary debt, because you're paying so much to the financial institution, and that's why your repayments always seem like they're going nowhere, right? So once you've paid back that amount, and that's the closing balance, the next repayment for the next month is going to be calculated on this amount, and this is why the opening balance is that amount. And now, because the repayment stays the same, you're going to pay more on your capital and less interest. So as you'll see here, the interest charged reduces every single month, and the capital repaid increases every single month until the end of the loan, which is 240 months, until you get a zero balance, only because the opening balance keeps reducing and reducing and reducing. But here's the most important thing: the interest charged. So in my home loan quotation, the interest that I would have paid for the 20-year period alone would have been 1.2 million. And my principal amount was about $1 million. Yeah, this amount right here, 1,02,800, right? So I would have, at the end of 20 years, paid for the capital and paid an additional 1.2 million rand, which is more than what I borrowed, right? So this is the scary part about interest. But yes, a home loan, I mean, nobody's got $1 million lying anyway, so you're gonna have to pay it, but you can control how much interest you pay. So you see that if you pay more capital towards your loan, towards any loan, it reduces the interest charged, right? If you pay more on this amount, it reduces the interest as well as the duration of your loan. So nobody forces you to pay this loan over 20 years. It's just that the bank is showing you that they're willing to take a risk with you for 20 years or 240 months. And then how you repay this is up to you, and how much interest you pay is up to you. You can pay more. When you pay more into your loans, then you definitely reduce your interest charged, as well as the term, the number of repayments. Okay. Now what I want to do is show you this interest was charged for the month of April. But what I'm going to show you is how it got to that figure, which is compound interest, right? But I'll also show you what simple interest is. So this amount, it's important for you to know, and this is why why I did this video, for you to understand. So I've broken it down from the quotation. I've given you what it looks like in real life. This is an amortization schedule. So the last part is for me to show you on a daily basis, because interest is charged daily and capitalized monthly. And what it means by capitalized monthly, it means that you pay on a monthly basis, and and this capital portion is subtracted from the balance. All right, I hope you learned something today, and I hope I'm scaring you not to take any more debt, or for you not to take unnecessary debt. So if you liked the video, please do subscribe to the channel, like, share with your friends and family, and yeah, that's it for today. Thank you for watching, and remember, the power's in your pocket.